Hey guys, Cameron here with Emerson Property Management. Every week I bring you tools, tactics, strategies, lessons I've learned, things that help me build up a sizable portfolio in about 2 años, 2 years, and now manage that portfolio. Today, guys, I want to talk about, as this market's changing, where we can find some investment opportunities or high ROI return opportunities in real estate. And then when you're buying, if you do buy in this environment, so there's kind of two things. That's one. And the second thing is if you buy in this environment, there's kind of two solutions or two philosophies that you can have about maintenance and deferring maintenance or doing improvements to prevent and make a really low maintenance type of property for your tenants so that your cash flow doesn't dip every month for 2 years or several years. So let's jump right into it. Let's talk about the improvement piece first and the low maintenance thing, and then I'll get to the ROI. So over the past few years, if you're a property owner and you're looking at ways when you're buying a property of, man, should I make this improvement? Am I going to get this return? I want to save money, costs are high. There's two really schools of thought when you buy a rental property. One, I'm making everything new. I want to go in and I want to replace the floors. The hot water tank's about 10 years old. I might get another few years out of it, but I want it to be brand new. Furnace, HVAC systems, 12, 13. I want to just replace it. That's new. I'm going to do a fresh paint. I'm going to do new granite countertops. Cabinets are 50 to 100 years old. I'm going to blow all that out, do all that new. You can spend a lot of money very quickly doing that. But you will not have to mess with anything for 5, 10, 20 years, maybe more. You go with hard surface floors, nice countertops, good cabinets, and good paint. The only thing you'll do between tenants is paint and little repairs here and there. You do a new water tank. Those are usually guaranteed. You have some sort of guarantee on those for a couple years, 5 years, especially in HVAC system. A lot of people guarantee parts and warranty or parts and labor for a certain amount of time as well when you install those. So when you install those systems, that's something to think about. Instead of, you're basically going to have a super high bill at the beginning and you're going to spend 40 or 50 grand, let's say. Then your maintenance cost, because you put in everything new and that means it's going to take some time for it to wear and tear, you're going to have very low monthly maintenance expenses or annual maintenance expenses if you want to look at it that way. So while your tenant's there, you're probably not going to have a call about the HVAC system doesn't work. You're probably not going to have a call about the pilot light went out. You're probably not going to have a call that, the carpet's ripped or the floor's damaged or a cabinet door fell off or whatever it is. You're probably not going to have some of those calls because you're dealing with new stuff. So that's one school. And then you spend a lot of money up front, basically. Your cash flow is a lot more standard over the course of the next 5 or 10 years. The other school of thought and another philosophy is just do what you need to do. Hey, HVAC system's 10 years old, but I might get another 5 years out of that. I'll leave it alone. I will spend some money on the floors because they're old or, doing a fresh paint job because it looks old, but you just do stuff as you need it. So you save that expense up front. You reduce that expense. Maybe you only spend $10,000. You just do paint and some new floors, you spend 10 grand. Once you have that in place though, you're going to have maintenance costs. So your income's going to kind of go like this over the next year. You're going to have higher annual maintenance costs. You want to make sure you get the HVAC service. You might have to pump it back up with Freon. You might have to, clean the A coils. You might have to do some different stuff there to make sure that system that's older is operating efficiently. You might have to flush the hot water tank and make sure clean the burner. There's several things you have to do to kind of maintain that. So I'm not saying one way is right or wrong. I can tell you that when I started, I did way number 2, which was I'll just fix what's needed to be fixed and then I'll deal with it as it comes on each turnover. I'll do some. However, now the properties I've been buying more recently, and I advise all the owners this, I would do way number one is I would spend the money up front. Now, don't be stupid. I don't mean, hey, you've got a perfectly fine hot water heater at 7, 8, 9 years old, and it looks great and everything's functioning, and you're going to replace it. You don't have to get that crazy. But if you have maybe a big write-off for something you want to do that year, you could do it. You can capitalize, you basically, you can depreciate that over so many years. So if you want to spend some money, you have a big bonus coming or something like that, and you have a W-2 job, that's a great way to do it. But I would just be more intentional about, if it's marginal, man, that stove looks old, replace it. That's what I'm doing now when I buy properties or when we have turnovers. And that way, again, my cash flow is so much more stable because I don't have all these high maintenance costs. And maintenance costs are a pain. They're a pain from a management perspective. It's the hardest part of our job is maintenance. It's that struggle with the tenants, vendors, and making sure that we get costs down. And nobody wants to see on their owner statement they spent $200, $300, $400, $500, $600 on windows and some doors and this and that. So I would go with the way one. Now, here is a way, if you guys have already bought most of your properties, maybe you're not looking for any properties now. We're still in this odd environment. I'm recording this at the end of end of October 2022, and interest rates are high and asset prices are still high. They've slowly started to come down, but they haven't come down enough to justify these high interest rates. So if you're buying, great, but over the next 6 to 12 months, you might find that there are some better deals coming down the line because prices are gonna come down. Maybe not. I don't know. That's what I think, but what do I know? If you do find yourself buying something, or maybe you're looking at these turnovers, or you have something turning over in the spring, this is something that a school, you're either gonna have to select one philosophy or the other, right? Boom, boom, whichever one you want to do. Maybe depending upon how much cash you have or whatever, you'll have to make that decision for yourself. But here's another thing, and this is kind of the first thing I was mentioning, is the return that you guys can find now. So I noticed on the properties that I deferred maintenance on, or deferred some of those improvements on, right? And I said, okay, I'm just going to do the bare minimum. I'll put carpet, I'll replace it with carpet. It's cheap. I'll deal with it later. Now I'm going in and I'm putting in hard surface floors, granite countertops, new kitchen cabinets. So I'm spending the money on the turnover, and now I can elevate the rents maybe $200 or $300 a month. So if you're having trouble finding a deal, again, like I said, the asset prices are up. I think deals are going to be better had here in the future, but you're going to be able to get an immediate return. So obviously in real estate, we want a bigger return than 10%. 10% is basically investing in the stock market. It's very liquid. It's very low time intense. You don't have to spend a lot of time messing with anything, because any CEO that if you invest in the S&P 500 index, all of those 500 largest company CEOs don't know who you are. They're not going to ask you to help them solve problems. They don't really care anything about you, and they're going to continue to deliver value for you month in and month out and pay you a dividend or whatever. So we want to be above that 10%. We want to make the juice worth the squeeze. So if you're looking for a 15 or 20% ROI, return on your investment, maybe spending 10 or 20,000 not on a new property, but on some upgrades. And let's just say you spend $24,000 on some upgrades and you can raise rents $200 a month. Well, that's a 10% return. That's not bad. That's better than the market, or that's about matches the market. So if you can spend $15,000 and do a $200 raise, well, now you're looking at even a better return. So think about that. If you notice that your property is getting a little dilapidated and you're still kind of hungry for, hey, I've got some money, but I just can't find a deal, I think this is a great opportunity for a lot of owners. Is now, especially with new builds and stuff coming down, some vendors are going to start getting hungry for work. They kind of wrote their own ticket there for 2 or 3 years, where we were in short supply of everything and they could just name their price. Now things are softening a little bit. So there's going to be some vendors who need some work. Well, when they need something, now you can say, hey, on this turnover, I want to do new floors. I think doing new floors and a new kitchen, spending $15,000, $20,000 is going to get me $200, $300, $400 more a month. That is a significant return on investment. So think about that. I hope that was helpful. Again, 2 philosophies: spend a lot of money on improvements up front and you have a lot of little deferred maintenance, or excuse me, you have very low maintenance throughout the tenancy, I like this option. I did not do this first, but I do it now. Or do the bare minimum that you need to in the beginning, and then you'll have more variable maintenance throughout tenancy until the turnovers come. Then you can do a big one or not, whatever you want to determine. But pick your philosophy. And then the second piece is, if you're looking for a return now, make sure that you're not just looking at it as, I have to buy another property. Look at the property you have. Is there a way to extract some value out of that? Can you go and put some money into it? Can you add parking? Can you add self-storage? I don't know, an ADU. There's all sorts of different options you have, but see if you can spend 10, 20, 30 grand on your property and elevate the value and get a significant return out of that. Guys, I hope that was helpful. If it was, let me know. If it wasn't, let me know. I appreciate y'all for tuning in. I'll see y'all next week.